pay attention for a second, because what I'm about to walk you through isn't opinion, it's math. And math has a way of exposing cracks long before headlines ever do. And right now, the silver market is flashing the kind of warning signals that only show up right before something breaks. Not slowly, not politely, but all at once. Because registered silver inside the main delivery vault system has fallen to just 88 million ounces, down from 200 million only a few months ago, which means more than 110 million ounces have vanished in barely 5.5 months, a pace of roughly 20 million ounces draining every single month. And here's the thing. The March contract roll that normally absorbs pressure and pushes traders forward is crawling when it needs to be sprinting, moving only about 15 million ounces a day, when historically it needs closer to 30 million just to keep the system balanced. And at this speed, the registered category is, mathematically, hits zero around March 6th. And that's not drama, that's arithmetic. And while most people are being told everything's stable, the Federal Reserve quietly injected $18.5 billion into the banking system overnight through emergency repo operations, the fourth largest injection since the pandemic era, which is not something you do in calm markets. That's something you do when liquidity stress is building beneath the surface, when something somewhere isn't clearing the way it should. And all of this is happening while silver inventories are being pulled west to east because Shanghai is paying a massive premium over New York, sometimes $9, sometimes much more, even after shipping and insurance, which tells you physical metal is flowing to where real demand lives, and paper price discovery can't suppress it anymore. And people will tell you, well, there's silver in the eligible category that can be transferred into registered. But here's the reality. The data already accounts for that. Registered numbers are net inflows minus outflows. And despite every incentive in the world to bring metal in, withdrawals keep exceeding deposits, which means there simply isn't enough loose silver left to satisfy delivery demand at current prices. And when a market keeps draining like this month after month, it reaches an inflection point where price must reset violently higher because physical availability stops cooperating with financial engineering. And that's exactly the phase we're approaching now. And what makes this even more explosive is that the rally you've already seen from the 30s to the 70s wasn't driven by wild speculative money chasing momentum. It was the opposite. Managed money positions in silver collapsed almost 90% during the price rise, meaning big speculators got shaken out while physical demand kept pulling metal out of vaults, which is the strongest kind of bull market there, is one where the paper crowd leaves and real-world buyers quietly drain supply. Because when speculative positioning is low and inventories are collapsing at the same time, you're basically sitting on a powder keg, waiting for fresh capital to realize what's happening. And now layer in something almost nobody in mainstream finance is talking about. Modern warfare is consuming silver at a scale the world hasn't priced in, not just for solar panels and EVs, but for circuit boards, missile guidance systems, autonomous drones, naval power systems, secure communications, high-precision electronics, and electrically powered submarines and torpedoes. And the United States quietly ran its strategic silver stockpile down to effectively zero more than 2 decades ago, which means every ounce used now has to come directly from the open market. And when multiple large-scale conflicts run simultaneously, the demand curve quietly shifts upward while supply is already strained. Shows when governments realize strategic materials are scarce. They don't bid slowly, they scramble aggressively. And that scramble doesn't show up in headlines until prices are already breaking. And if geopolitical tensions escalate further, especially with major military positioning now openly discussed in global media, markets don't just reprice oil and currencies, they reprice everything connected to strategic resources, metals included. And at the same time, the silver to gold ratio is sitting around 64-1, while the natural mining ratio is closer to 8-1. Vault ratios are even tighter, which means the physical reality of silver scarcity is wildly disconnected from its price relative to gold. And historically, when that kind of divergence stretches this far, it doesn't gently normalize, it snaps violently, and you see it expressed as sudden price surges that catch most people completely off guard. And while institutional surveys keep claiming gold is a crowded trade, those same surveys said the same thing back when gold was in the low 3,000s before it surged thousands higher. Because institutions almost always label something crowded after it's already rising instead of understanding why it's rising. And when you zoom out at asset allocation, precious metals and miners make up barely 4% of global assets today compared to roughly 24% for much of the 20th century. Which means even a return to historical norms would require metals to outperform nearly everything else for years, not weeks, not months. And yet most portfolios are positioned as if metals don't matter at all. And here's where all of this connects. You've got 20 million ounces disappearing every month. You've got a delivery system that mathematically doesn't work at current roll speeds. You've got physical metal flowing east because paper pricing can't suppress real demand anymore. You've got speculative positions, historically low. You've got military consumption quietly accelerating. You've got central banks injecting liquidity again. And you've got global allocations to hard assets near historic lows. And none of those conditions point to stability. They point to pressure building inside a sealed container. And sure, there are always bearish possibilities. Geopolitical moves could be delayed. Liquidity injections could calm markets temporarily. Recycling could add some supply. Contract rolls could speed up late. But none of those change the core math. And the core math says inventories are collapsing faster than the system can replenish them. And lower prices don't bring supply and shortages. They usually make shortages worse. Because miners can't instantly increase production, and holders refuse to sell into artificially suppressed markets. And every time history reaches this stage of depletion, price doesn't adjust slowly. It gaps higher violently when reality finally overwhelms the paper structure. And what most people miss is that these resets always feel impossible, right up until the moment they happen. Just like housing in 2008, just like tech in 2000. Just like oil spikes, just like currency crises. The math always warned first, while narratives tried to soothe. And right now, the silver math is screaming, not whispering. And it's screaming that physical supply is being consumed faster than it can be replaced in a world where demand is rising, not falling. And when you combine resource depletion, geopolitical tension, monetary stress, and extreme under-ownership, you don't get a gentle rebalancing. You get a repricing event, the kind that rewrites what people thought was possible in a very short window of time. And that brings us to the real question that matters. Not whether silver moves tomorrow or next week, but what happens to global financial stability with strategic materials, monetary confidence, and geopolitical risk all collide at once. Because history shows when those forces converge, markets don't drift, they reset. And usually in ways that shock almost everyone watching. And if the math is already breaking, while most people are still being told everything's fine, the real move probably hasn't even started yet. And the uncomfortable truth is that by the time it becomes obvious, it's usually far too late to prepare.